Welcome to The Explainer. Now imagine waking up. It's January 1st, 2026. You look at your accounts and you've got $0 in assets. No stocks, no bonds, and maybe even a little bit of debt holding you down. And of course, the financial headlines are just screaming about interest rates and the rising cost of living. Look, it is incredibly easy to feel totally paralyzed and just assume the whole game is rigged against you. But today, we're diving into a genuinely empowering roadmap based on current financial research. We're going to look at exactly how you can go from absolute zero to financial abundance using a strategy purpose-built for the real economic realities we are living in right now.
So how do you actually build wealth if your starting line is absolutely $0? It's a huge question, and honestly, it brings up a lot of anxiety for folks who are starting out with empty pockets or even a negative net worth. But here is the amazing truth. The roadmap to your first 100 grand and eventually your first million is completely mathematical. We are not talking about getting rich by Tuesday. We're not banking on a lucky lottery ticket or some wild overnight crypto scheme. Nope. It is about a calculated, step-by-step progression that builds real, rock-solid wealth, as long as you simply follow the process and tune out all the noise.
Okay, here is our agenda for today's Explainer. We're breaking this journey down into 6 logical phases. Escape the starting line, build an ironclad foundation, the compound growth engine, making your first investment, managing risk and emotion, and finally, maximize with tax shields.
Let's jump right into phase 1, escape the starting line.
Before we can even think about investing, we have to clear out the financial anchors that are dragging us backwards. There's this super pervasive myth out there that you can just out-invest your bad financial habits. You might think, well, the stock market usually does about 10%, and my credit card debt is 20%, so I'll just start investing now and catch up later. Guys, that is the negative compounding trap. If you're sitting on high-interest consumer debt, your net worth isn't zero, it is literally negative. Mathematically speaking, paying off a credit card with a 24% interest rate is a guaranteed 24% return on your money. You absolutely cannot find a guaranteed return like that in the stock market without taking on catastrophic risks. So the research points to the avalanche method here. You list your debts by interest rate, and you aggressively destroy the highest rate one first.
All right, moving on to phase 2, build an ironclad foundation to prepare for emergencies.
We really need to draw a hard line in the sand here between saving and investing. Saving means setting money aside in insured bank or credit union accounts. It's your safety net for short-term protection, grounded goals, and emergencies. Investing, on the flip side, means actually buying assets like stocks or bonds, with the thrilling expectation of making a serious return over the long haul. Basically, cash protects you in the short term, while investing is purely for your long-term growth.
To properly build that solid foundation, you need to establish what financial researchers call a cash fortress. This means saving up 3 to 6 months of bare-bones survival expenses. We're talking rent, food, utilities. You want to put that into a high-yield savings account. Now, it might sound kind of boring, but this cash buffer is actually your ultimate superpower. Why? Because if you lose your job or your car suddenly breaks down, you will not be forced to panic sell your stock investments at a massive loss just to buy groceries. The math always favors the investor who never has to sell at the wrong time.
So with your cash fortress fully stocked, we hit phase 3, the compound growth engine.
Now, this brilliantly illustrates the legendary snowball effect. Compound growth happens when you earn a return on your invested money, and then you earn a return on those returns. It just keeps stacking. Look at this chart. If you set aside just $100 a month for 40 years, assuming a pretty standard 7% return, notice how that flat blue line representing your actual cash contributions gets completely blown out of the water by the exponential orange line of compound growth. It's incredible.
What's really fascinating about this table is the sheer urgency it creates. Just look at the starting ages. If you start at age 18, reaching $1 million by age 65 takes just $254 a month. But man, if you wait until you're 45 to start, that monthly number skyrockets to over $2,000. It's wild. It perfectly proves that while our feelings might lie to us, the math absolutely does not when it comes to the monumental cost of waiting.
All right, we know the why. Let's step right into phase 4, making your first investment.
Let's completely shatter the old myth that you need thousands of dollars just to get started. The barrier to entry has totally vanished. You can invest your very first $100 in 3 highly accessible ways today. Number 1, robo-advisors. These use algorithms to manage a fully tailored portfolio for you for just a tiny fee. Number 2, fractional shares. Platforms like M1 Finance lets you buy a microscopic slice of massive companies, think Amazon or Google, without dropping thousands on a whole share. Or number 3, a micro business.
You can invest that $100 into some basic equipment to wash cars, rent a truck, or even pay for blog hosting.
Now, if you bypass the robo-advisors and decide to invest on your own, your absolute first step is to establish a clear financial plan. Ask yourself, how much are you going to invest? For how long? You have to do your own real research using official resources. Please, whatever you do, do not blindly follow hot stock tips from a neighbor or some trending post on social media.
So, you might be wondering, how do you actually beat the stress of market volatility? You adopt a strategy called dollar cost averaging. It sounds a bit fancy, but it just means investing your money in equal portions at regular intervals, regardless of whether the market is up or down that day. By automating this consistent strategy, you completely remove the stress and, honestly, the total impossibility of trying to perfectly time the market. You simply end up buying more shares when prices are cheap and fewer when prices are high, completely smoothing out your risk over time.
Which brings us perfectly to Phase 5, managing risk and emotion to protect your wealth.
To really protect your wealth, you have to recognize that the biggest threat to compounding is usually your own psychology. A remarkably reassuring tactic to overcome the anxiety of starting is what's called the one-share test buy. Literally, you just buy a single share of a stock to practice implementing your strategy. Because it's only one share, you totally remove the emotional baggage of greed or the paralyzing fear of a massive loss. You get actual skin in the game, which allows you to focus purely on executing your plan and tracking percentage growth rather than sweating over a huge dollar amount. As you start building out from that very first share, you absolutely must remember diversification. You've heard the saying, don't put all your eggs in one basket. Well, it's a massive cliche for a reason, because in investing, it is entirely true. It's a recipe for disaster. If you only own one company's stock, and that company fails, your entire portfolio is wiped out. This is exactly why broad market index funds are considered the ultimate tool for everyday retail investors. They track a massive basket of stocks, so if one specific sector drops, another one might rally to break even or even post gains for you. This leads directly into a super powerful, psychology-proof portfolio setup known as the core satellite approach. Here's how it works. You put 90% of your investable cash into boring, broad market index funds. That is your core. It does the heavy lifting and you literally never touch it. Then you take a strict 10% and allow yourself to use that to pick individual stocks or alternative assets. This safely scratches your psychological itch to actively trade and go after those big gains, but without risking your entire financial future if those satellite picks happen to go to zero.
Let's move into the final advanced step. Phase 6, maximize with tax shields.
This is exactly how you protect your profits. You see, you could pick the absolute perfect funds and automate all your savings, but if you don't optimize for taxes, you are basically volunteering to hand over a massive slice of your compounded wealth to the government. So you want to use the waterfall method. Visualize it as a procedural checklist to legally shield your money from tax drag. Step 1, contribute to your 401k up to your employer's match, because guys, that is literally free money. Step 2, max out your Roth IRA for tax-free growth. Step 3, if you're eligible, max out a health savings account, which is famously triple tax advantaged. And finally, step 4, flow back and max out the rest of your 401k limits. You should only really invest in a standard taxable brokerage account after all these tax advantage buckets are completely full.
Okay, the final piece of this wealth building engine is your income. You can only optimize your taxes and cut your expenses so much, right? There is a hard floor on saving, but there is absolutely no ceiling on your earning power. The research highlights this amazing concept called the skill audit. It means dedicating just one single hour a day to mastering a high-leverage skill, something like data analysis, coding, or project management. Increasing your primary income makes every single other step we've covered today work 10 times faster.
I absolutely love this quote, and it really just says it all. Defense prevents you from losing, but offense is how you win. Clipping coupons and avoiding debt is a fantastic defensive game. But if you want to truly accelerate your wealth engine, you have got to play offense. You have to shift your entire mindset from merely trying to save $5 to actively earning $5,000 by upgrading the value you can bring to the marketplace.
So, as we wrap up this explainer, I want to leave you with this final provocative thought to take with you. What is the one skill you can master today to accelerate your wealth engine tomorrow? Don't wait around until everything in your life is perfectly aligned. Take action on your financial journey today. Thank you so much for joining me on this explainer, and I will catch you